Hey everyone, welcome back to Upside Down Data. In this video, I'm going to be talking about the long-term and medium-term UDPI risk charts for Bitcoin. So if you like the content, subscribe to the channel, give the video a like, follow us on Twitter, where we put out regular updates about our risk indicators and more. So what I've got up here are the risk gauges for Bitcoin at the long and medium term. This is the UDPI, the upside downside potential indicator, which is our in-house risk indicator here on the channel. And it's scaled from -5 over on the left in green to +5 over on the right in red. And when you see a green reading, especially lower readings closer to -5, that indicates that risk is relatively low at that point. There's limited downside potential that the model considers to be realistic, but extensive upside potential. And the opposite obviously is true on the right. When you see a red reading, especially higher readings closer to 5, that indicates higher risk, more downside potential, and less upside potential. And so we have these for multiple time frames. We actually work with 3 time frames. I'm going to be focusing on 2 in this video. So the long-term time frame is meant to track moves and assess risk on a scale of months. So this is a really patient model. It's not going to be reacting to short-term volatility unless it considers that volatility to be diagnostic of longer-term risk, which means that it takes it in a longer-term context. The medium term is meant to be interpreted on a scale of weeks to months. So it's still a relatively patient indicator, the medium term. It's not going to be reacting to intraday moves, but it's a little bit more reactive than the longer-term indicator. And so we can look at these alongside each other, and that tells us something about the price action dynamics on Bitcoin. It tells us about the time frame in which the volatility is occurring, if there is any volatility. And what I want to draw your attention to is these 30-day charts for starters. I'm going to pull up another chart in a moment that'll give us an even closer look at this and also a look at longer term time frame. But we're looking just at the last 30 days of these readings. So these daily readings for the long term on the left and the medium term on the right. And we can see the trajectory that they've each been following over the last 30 days. And what's clear is that the long-term UDPI is still in a downtrend. The risk is still dropping. It's approaching -2.7. And, before long, if it continues on this path, it'll be approaching -3. Whereas the medium term has flattened out and has actually started to tick back up a little bit over the past week or so. The medium-term UDPI has actually been increasing in risk, which means that it's returning toward the zero midpoint. So it was a little bit lower risk a week ago, and now it's turned around. And so what we have here is a divergence between the long-term and the medium-term UDPI. And so I want to introduce the concept of a divergence on these different timeframes for the UDPI. And it's something that I'll be exploring more in future videos, but I want to take a preliminary look at it and see if we can identify trends, patterns, anything on the chart that relates to this kind of divergence and see whether we can learn something from it. So let's pull up the UDPI for long and medium term for the entire price history of Bitcoin. So what we've got here is the medium term in red and the long term in green. And these are just superimposed over each other. And so again, what we're trying to get a sense of is just how these move in relation to each other. And how does that correspond to the price action at the time? And as I mentioned, there's a lot here that we could talk about and very likely will in future videos. But I want to make a few observations. Well, first of all, let's just take note of the fact that we see this reversal on the medium-term chart here, right at about -2. There's a reversal that, we have to wait to see if it continues, but it is there on the chart, no doubt about it. But at the same time, the long-term risk in green is continuing its downward trajectory. And so that's this divergence that I'm referring to. But I want to make 3 generalizations about this chart. So the first generalization is that the medium-term risk is rarely more extreme than the long-term risk in either direction, right? Usually, the medium-term risk is closer to the midpoint than the long-term risk. So if we look back here in 2012 and 2013, we see a very low level of risk on the long-term chart, a little bit higher most of the time on the medium term. And then this next phase between 2015 and 2017, a similar kind of pattern played out. Whereas if we look to the upside, we see that there are sometimes peaks where we get the medium term becoming more extreme than the long term. Get that here in the end of 2013. We get that here the end of 2017. We also see that here at the beginning of 2021. We see it again here more recently, just this past few market moves in 2021. So it does happen, but it's pretty infrequent that the medium-term risk is more extreme. And by extreme, just to be clear, I mean, further negative when it's in negative territory and further positive when it's in positive territory. So this is not more extreme. When I'm pointing here at this kind of 2015, 2016 period of time when the medium-term risk was higher and the long-term risk was lower, that's not more extreme. That's less extreme for the medium term because it's closer to that zero midpoint. And to remind you, the zero midpoint is an equilibrium. So that when we're seeing relatively neutral risk readings, that means that that's a potentially relatively stable kind of place to be. This is a mean reverting indicator, which means that the more extreme, the further we are from that midpoint, the less sustainable we expect that to be. And so most of the time, we'll see that the UDPI will revert over time, not immediately, but over time toward that zero midpoint. So again, the medium is not very often more extreme in either direction. Another thing that we can observe here is that the long-term UDPI can stay lower for a long time. That was the case in 2012. That was the case in 2015 and 2016. These were extended periods that corresponded to bearish times largely that saw the long-term UDPI spending extended periods of time, weeks and months, well below the level of risk that you see on the medium-term UDPI chart. That's noteworthy because that's one way to interpret what we're seeing right now. We have a growing discrepancy between the medium term and the long-term risk charts, whereas the medium term is now bouncing up off of 2 and moving back toward -1. The long-term chart is continuing downwards, passing -2 and approaching -3. So for the time being, that looks like it could continue to grow. And in the past, we've seen that those periods of time can last for quite a while. The last observation that I want to make about this is that oftentimes, not every single time, but oftentimes the most convincing reversals come when the medium is as extreme or more extreme than the long-term UDPI risk chart. So, that was the case in 2013, especially before that final blast off or the really parabolic move, that second move of that market cycle. So in late 2013, that was also the case in the 2017 run-up, where the medium term actually dipped down lower to a more extreme low risk value in the middle of 2017. And then the whole market bounced up. And then once again, the medium came down and went lower, more extreme toward the downside than the long term. And that preceded the famous 2017 parabola. That's another case where that happened. So here's yet another one in late 2018 in December. The medium and long term bottomed on the same day, in fact, and that preceded a run up. And then in March of 2020, the COVID capitulation, which is, maybe not typical of market cycle bottoms in certain ways. I mean, it technically wasn't the market cycle bottom. It didn't go as low as that December 2018 move, but It was a pretty dramatic capitulation. And again, there, the medium-term UDPI risk gauge flashed a reading that was lower than the long-term one. As I mentioned, that doesn't tend to last very long, and that did precede a pretty significant move up, which eventually turned into that late 2020 run up after, that involved breaking the 20K all-time high and then running up much farther than that. On the other hand, that did not happen back in this most recent kind of intermediate bottom, this mid-market cycle bottom back in May and June of 2021. There we saw that the long-term risk got lower than the medium-term risk, or the medium-term risk never caught up with how low the long-term risk was. And that move was not ultimately very convincing. It did make a new all-time high, but not by very much, and it capitulated back down through that level, back into the range, back down to the low 40s where we find ourselves now. So, this bottom back in the middle of 2021 was not showing a lower level of medium-term than long-term risk. And then what we saw was the run-up showed the opposite. Medium-term risk got out ahead. It got higher than the long-term risk. And as I've noted, medium-term doesn't usually stay more extreme in either direction than long-term. And then we got a move back down. So that move started with what I would consider to be historically the non-optimal base for a parabolic move to the upside, where long-term risk was well below medium-term risk, and then medium-term risk got higher than long-term risk, which tends to be followed by a correction. So these are just a few observations here, and it's clear that the current moment is not showing us that, that medium-term low risk scenario where it's as low or lower than long-term risk, which would happen if there were a very volatile move to the downside. Oftentimes that's what it takes to kickstart a new market cycle, is a capitulation, a wick down to the downside, a very dramatic volatile move that shakes a lot of people out, liquidates a lot of leveraged positions, and kind of resets the market to an extent. Whatever's happening now, maybe the bottom is in. It's very possible that the bottom is in, but whatever's happening now, it hasn't come to pass like that. And so based on looking at some historical examples here and thinking about how that relates to the price action, it doesn't seem that we're moving toward a trending market. It doesn't seem necessarily like we could be seeing a major bounce back toward an all-time high in the very near future. It looks more like this might be the risk resetting, entering a new normal. It's entirely possible that we'll have a period of time that looks something like this, where the long-term risk stays below the short-term risk for quite a bit. That's a possibility. It is also possible that we're just setting up for another kind of another bounce, which could be substantial in terms of percentage, but might not be totally convincing if it's anything like the middle of 2021. So this is just an attempt to map on what we're seeing right now on the long and medium term risk charts to some previous events. It could play out totally differently. Something totally unprecedented could happen. But, history does rhyme, and I thought it would be useful to take a look at this and to kind of introduce this way of analyzing things, because I think there's more to think about here and some more analyses that we can do in the future. So this will be a good start. I hope you guys found this useful. Thanks for watching.